Good evening, everyone. This is Vittal from National Stock Exchange. Thanks, everyone, for joining on this webinar. This is a series of webinars which we are conducting for the benefit of market participants and investors as a awareness and education initiative for NVIX futures. Last time we conducted a webinar where we had invited one of the international experts, Russell Rhodes, from CBOE, to talk about the volatility indices and its utility for trading derivatives on volatility indices. I think we had received a very fantastic response from all the participants, and based on the feedback from market, we are conducting this series of initiatives of this webinar. And today we have eminent panelists. We have basically leading research heads from India. Starting with, it's my pleasure to introduce Mr. Siddharth Bhamre, who is Head of Equity Derivatives at Angel Broking. Siddharth has graduated in Science from Mumbai University, and he has received his MBA in Finance. Siddharth is a frequent speaker on leading news channels, and he is a master on equity derivatives. And I welcome Mr. Amit Gupta, who is AVP and Head of Derivatives at ICICI Direct. He is also a frequent speaker at leading business channels. Amit has more than 10 years of experience in this area, and he is supporting institutional as well as retail clientele. So welcome, Amit. Then we have Mr. Yogesh Radke, who is the Head of Quantitative Research, Institutional Clients at Edelweiss Securities. So Yogesh is a frequent speaker again at all the news channels, and he heads the quantitative and derivatives research at Edelweiss. He is a graduate in statistics and mathematics and holds a master's degree in finance. So I welcome Yogesh to this panel. So I'm sure this is going to be a quite interesting webinar for all of you. And for the participants, if you have any specific queries, you could type in your queries at the bottom of the text box which is provided on your screen, so that our panelists could take up those questions and provide responses accordingly. In case of want of time, if we are not able to take up any questions, we would record these questions and we'll revert to you with the responses. Thank you. So let me start this webinar with Yogesh. So Yogesh, could you explain us what is the concept of volatility and what is relevance for the market participants?
Sure, Vittal. See, largely if you speak as volatility index, it's the indicator to gauge the fear in the market or the expected volatility in the index in the upcoming days. Now, how is it relevant in terms? It's to gauge that will index really sharply move up or down in the upcoming days. If surely the index, the VIX is at a lower level, that means market is not expecting high volatility in the market. But on the other hand, a high VIX index indicates that there will be an expectation of a sharp movement in upcoming days. So as per that, market can gauge it and also realign your portfolios to high beta or low beta stocks depending on that. So this is a useful tool for directionary trading also, and also to take a view on the market before you go into high beta or low beta stocks.
Thanks, Yogesh. As all of you are aware, like NSE has been computing India VIX index from 2009, and real-time index dissemination started from July 2010. And I'm sure all the research desks are currently tracking India VIX numbers. So let me ask Amit, could you just inform our participants as to how the researchers are currently using India VIX index for their analysis and for devising any trading strategies for investors?
See, India VIX, as you know, generally it moves in a range of 15 to 20 normally. So what generally the market participants do, whenever it goes up, generally the high volatility scenario, so either you go short in the volatility, like when you go short in the stock when it moves up, or when the volatility comes down, let us suppose it comes down to 14, 15 levels, again the people try to go long in the volatility. But what I feel is, when you see the market, when it this time it has broken down below 6200, we saw the volatility suddenly increased. So the people who were anticipating this kind of breakdown, they went long in the volatility and they made money. Now, if you look at afterwards what happened, despite Nifty coming down, the volatility remained in the range and rather it came down. So that means you need to be very apt in understanding this particular feature of volatility. Generally, it works on breakdowns or breakouts. And if you are able to capture them, then you can definitely play long or short in the volatility. And we can do this because previously India futures were not there. So we were doing this with going long in index options or going short in index options. That is how it works.
Okay, great. So now NSE, as all of you are aware, like NVIX futures, our futures on India VIX index, which are being launched on February 26th. So this Wednesday, which is going to make available a tradable instrument on volatility index for participants. So Siddharth, could you just throw some light on how NVIX futures could be useful for augmenting the existing trading strategies or devising any new trading strategies or for any uses by market participants and investors?
Sure. There are two types of volatilities. One is historical volatility and one is implied volatility. Now, historical volatility is volatility which has happened in past, which everybody of us know. Implied volatility is volatility which is going to happen in future. When I say it's going to happen, in the sense that is what participants are expecting it to happen. Where this is captured in option prices, which we call implied volatility. And combinations of all the strike prices and assigning different weightages to them according to different methods of calculation, VIX index has been formed by exchange. Now there is an inverse correlation. 90% of times we have seen that if market goes up, volatility comes down, that is VIX, and when market goes down, VIX goes up. So generally, if somebody wants to use it as an hedging tool, you have to take a corresponding position. Simple example, say if I have a portfolio, the launch is happening on 26th as you're saying, and elections are coming. So obviously before election, there would be good amount of volatility. There will be people who would be worried about their portfolios on the upside or downside. So how do they hedge their portfolios? By using VIX. As election arrives and so would the results of election, more and more people will try to buy options. Now once they start buying options, the implied volatility of options goes up. I have a portfolio, I want to hedge it. So what I do is, probably a month before, I start forming long positions in VIX index, provided, as Amit was pointing out, that VIX moves in a range. We are in a range bound to slightly upward side market, where generally our observations is that VIX moves between 14-15 on the lower side, 24-25 on the higher side. Say suppose 1 month before election, if your IVs or VIX are trading at say 15 levels, to hedge your portfolio, you should also go long in VIX futures. So whatever quantum of your portfolio is, finding out the beta of your portfolio along with the VIX, you have to go long in VIX future. Say in elections, there is a unfavorable outcome and market corrects significantly. You will see that implied volatility going up. VIX will go up, but your portfolio will go down. You were long portfolio, you were long VIX, and hence this would work as an hedge. For participants, I believe it is not just an hedging tool. Certainly, hedging is the main objective, but there are a lot of traders who seek volatile movements in underlying, who are always in search of some underlying which is volatile and want to place their trades there. Volatility index is very volatile. It can move from 15-16% to 20-21% in matter of 2-3 days also. So what we are talking about 30-40% movement in single week, which is a big move. So even traders would have a lot of active interest here, and we are very positive on this product and how it can be used not just by investors to hedge their portfolios, but also by a lot of traders who today in option segment are very active. We are seeing our option market, which today constitutes 75-80% of total turnover. We expect a lot of them to have quite good interest in this volatility index as well. So we are quite positive.
Thanks, Yogesh, for this Siddharth. So as we understand, hedging of the equity portfolio for volatility risk could be one of the uses of NVIX futures once it's available for trading. So Yogesh, I would like to hear views from you. Like apart from hedging, like what could be the other alternative trading strategies which could be formed?
Right, Vital, you rightly said that apart from hedging, there are multiple uses of the VIX futures. Obviously, going directionally long or short on the volatility itself will be available via VIX futures. Currently, what is done by the options, you are now getting as a ready tool to trade volatility. That's first thing. Second, I would say that you can trade spreads between the two futures. So, like, these are weekly futures which will be available. Now, obviously, as we see that in a monthly options also there are volatility spreads. So now this can be captured via these futures also. So if you expect that current month volatility is at 14%, next month volatility is at something like, I can say, 18, 19, 20%. Similarly gets reflected into futures also. So current week vis-a-vis the further week, there's a spread. If you're betting on this spread, you can go long on the spread or short on the spread via futures, rather than going into the complex strategies of your options and all those things. So it's a ready tool for even a simple guy or a retail participant also to just express his view on the market by going long or short on the futures market. Now, third, what I will say that this is slightly on an institutional part. Now, the institutionals are having huge option portfolios. Now, they want to hedge their Vega risk. So now Vega is something which is the volatility. I want to bet on the market movement but not on the volatility. So I have created an option portfolio but I don't want to bet on volatility. So I can go short in the futures to hedge my volatility risk also. So this is something opposite to the people who want to bet on volatility. I'm talking about the other participant who want to reduce the risk of the Vega in his portfolio. So that is one of the very important tools. In foreign markets, if you look at even the CBOE VIX, there also people use this tool to hedge their Vega risk in the portfolio. That is really, I must say, a very new aspect which come into the Indian markets, where without trading the options or selling the volatility there, you can directly trade in the futures market. So that is like one of the four things which can be useful. There, I am sure that as the product develops, there will be multiple, strategies which can be designed, because currently market is looking forward that what type of trading will happen, what is the bid ask, how the screens will be looking at, and then we can really design the strategies, products around it to make it more user friendly and more, a tool which can be really making money out of it.
Thanks, Yogesh. Amit, what are your views on possible trading strategies, how this product could augment and assist the participants?
Yes, Siddharth mentioned about the speculative part of this product. I think that is something that initially we can look at. If you look at near expiry, generally we have seen that the theta is more dominant over the Vega. These are the Greek options, and that's why the premium of the option they decline, whether it is a near month has to decline because the expiry is near. The next month options also the premiums decline. So if somebody is speculative on India VIX, he can go short in India VIX near the settlement period, because it's a very clear sort of trade that is happening. Another thing, before the events, now again you can go long in volatility, where you can make use of the higher premiums of options, because people generally go long in Nifty options, and that's why India VIX premiums also, prices also increase. So these are some speculative bets. Along with this, I think why you have introduced the weekly product, weekly expiry, could be because as far as I understand, there have been 4 or 5 very sharp moves in volatility during the month. So one can capture this with different settlement periods. So that is another benefit of this short expiry one can use. Along with this, when I come to the little bit hedging strategies or the delta neutral kind of strategies, for an example, right now market is quite range bound. We are seeing it is hovering around 6200. Now you can go short in 62 call and put option. This is what we call as a delta neutral strategy. Now what can go against this strategy is the increase in volatility. So you need to make a gamma neutral strategy now. That's why what we do, because so far India VIX was not there. We were going long in OTM call and put option. That is what we call as the butterfly or the condor spreads. Rather than doing this, we can directly go long in India VIX future and do the gamma neutral part of this particular strategy. So you will have only 3 legs. One is 62 call and put, you will sell, that these are 2 legs. The third one is the gamma hedging part. Now this is another very good part that we can use India VIX. Another feature, generally what do I do? I go long in call and put options because I want to make use of the increase in volatility. It could be because of an event, it could be because of the very heavy short buildup in the market and you feel the market has come closer to the support and immediate short covering may come, or the breakdown scenario. You go long in volatility. I generally go long in options because we don't have any other option. Now, India VIX, let us suppose Nifty 60, 100 put and 6300 call I bought in anticipation of any sharp move. If it doesn't come, let us suppose if it doesn't come, and India VIX remains constant, I am not saying the volatility is coming down. If it remains constant and the premium suddenly decline because of the theta, the time decay. So in the current scenario, you make loss because of this. But if you have India VIX future, rather than going long, in Nifty options, I can directly buy Nifty futures, India VIX futures. So even if it remains constant, at least I will not make loss. And if it is increasing, then I will make money. So these things are very important. Another, if you give me some time, I can give you one more example. See, if I am going long in options, the same example of 61 put and 63 call, and I do it at a volatility, implied volatility of 12%. Let us suppose 12%. Number of trading sessions in a month are generally 20. 12% divided by 20, it comes to 0.6% for a single day volatility. That means at 6,100 of price of Nifty, I am expecting movement of 35-36 rupees. So if that is not coming, 35-36 rupees of movement, it can come either through a gap up or gap down immediately. That can impact the volatility. If during the trading hours, slowly if it is coming, it will not give you money. So that's why I think if you are long in volatility, so even if it remains constant, you will not make loss. But in case your view goes correct and the gap up or gap down suddenly happens or the immediate movements happens, you will make money. So that is how it is a better product in comparison to what strategies we are using right now in Nifty options.
So, Siddharth, you mentioned about the hedging of the portfolio. So currently there are some of the different options which are used by participants for portfolio hedging. And this product, as per you, could be more effective hedging of the existing portfolio, which could be attained with this product. Could you just give some example for layman investors to understand how exactly this hedging could be done?
I will take a reference of what Amit mentioned in his second last point, that whenever you have a call on volatility, today people in India, to our disbeliefs, are quite educated in terms of options and their pricing. They may not be as sophisticated in terms of, terming it Vega, Theta, Gamma, other things, but they are aware of, how premiums are moving. What Amit mentioned, that though I take a call on, today, last week of expiry, we are in last week of expiry. IVs are around 14-15%. We are expecting implied volatility to go up, say VIX to go up from current levels. But our view is that it would go up probably in, say, 6-7 days. But if somebody is taking exposure, then he is vulnerable to theta movement. He is also vulnerable to delta movement. When I say theta movement, I am talking about time decay. When I talk about delta movement, I am talking about underlying prices moving haywire instead of volatility moving. So VIX addresses that problem. So which is rightly pointed out by him, that VIX addresses your delta. They make delta and theta neutral for you, and you play only on volatility, and that's a big market. Big market for institution, big market for retail also, and even retail guys are very active there. How we hedge it? I mentioned earlier that how you can go long portfolio and long VIX. It cannot be opposite, that if you want to hedge your portfolio, that you go short VIX. It depends on the VIX. Now VIX is a range bound product which completely, participants need to understand. IVs over a period of time, what we have analyzed is, they, though in a range, in different kind of market scenario, they move in different zone. One may call it mean reversion, but we have certain other ranges for it. Like in bull market, our observation is that VIX moves in a range of 13% to 20-21%. So a 13%, 14% is low, 21, 22 is high. In a bear market, a 20-21% IV is low IV. 30-35% IV can be a high IV. In a range bound market, you have IVs ranging between 19, 12. So you first need to understand, even if you are hedging using VIX, in which kind of market scenario you are into. there is no single point that VIX will always come to those levels in any given kind of market scenario. How I hedge it? I mentioned that you go long VIX. At the same time, it is not just hedging about your portfolio. You can hedge your trading positions also by using VIX futures. Now, there are so many people who are long stock futures, long Nifty, but it is not at current levels they are long. Say they are stuck. Today, market is around say 6150, 6170, but people are carrying their long positions from 6400. Now, how even they can hedge it? They hedge it by going long VIX. So, your portfolio and your VIX future, you both are long, and if VIX is at lower levels, then only it would be termed as hedge. You cannot go short VIX future and long portfolio. That's not an hedge.
Thanks, Siddharth. Yogesh, you mentioned about opportunities in spreads. So,
Right.
Because NVIX futures will be weekly contracts. At any point in time, there will be 3 weekly futures that would be available for transacting. So, what kind of opportunities you see in case of spreads going forward?
Sure. See, obviously we'll have to see that how the spreads really pan out on the screen. As I said, that market participants will view, analyze things that how the spreads are moving, and then really the bets can be taken there. But here I believe that the spread margins would be low, and you're really playing for a thin spread which is between the current week and next week, and you roll as we do currently in the actual and underlying futures like Nifty futures. You trade the spreads. You have a view that the 35 points is low or high, and you buy those points or sell those points, and then you trade the spreads. Similarly, in VIX also, I'm quite sure that you'll find the spreads, and you can provide the liquidity to the system also by doing these spreads. A thin margin would be there, but still that would yield out to a strategy which tries to focus on expansion or contraction of the spreads between the 2 weeks even. Obviously, the contracts are just for 3 weeks time frame. If it would have been slightly on, say, higher end, as the liquidity comes in, surely I'm sure that the exchange will provide these longer dated futures also. But currently, between the weekly contracts also, you'll find good amount of spreads to be traded.
Sure. Thanks. Coming to the next question, what we have heard is post 2008 financial crisis, volatility has become an essential part of portfolio of investors. So, in fact, there are many case studies which are available, which states that having exposure to volatility as an asset class would have helped investors in better portfolio diversification during specific turbulent times. So, Yogesh, could you just throw some light on what could be the additional opportunities that would be available specifically for portfolio diversification perspective?
Sure, we'll see. I'll say that it's too early for as an Indian say traders to add this as an asset class to his portfolio, given that Siddharth rightly mentioned that there is say around a volatility of 60 to 70% inside the VIX index itself. So on one side you are adding an asset class which is very volatile in nature. You may gain when there would be rise in the volatility sudden or sharp, but I would say that still it was too early to add this instrument as an asset class to your portfolio. But as you rightly said, it's good to have a diversified portfolio where you also want to bet on volatility. You can have certain proportion of your portfolio to be allocated into the VIX future. Now, as the days come, we will see that how the liquidity pans out, how the volatility comes into picture, and does it really adds up to your portfolio as an asset class, or it's a hedging tool for your portfolio. So it's like two parts what we are talking about. One, the instrument as a hedging tool for your portfolio. Second is a part of your portfolio itself.
Okay. Amit, would you like to add any views on this?
One thing is there, if I keep aside India VIX future right now and just look at the spot India VIX, see what does it mean to me? First of all, how this particular India VIX is derived. In Nifty options, the best part is India VIX takes only the out of money options. It does not take in the money options. Now, if I am taking out of money options, that means I have kept delta aside. I am just looking at the theta part, I am just looking at the volatility on this, and then I am coming to the near month and the next month options. I am taking all the strikes where the OTM puts and OTM calls are there. I am taking the variance, the standard deviation of both the series, and finally I arrived to India VIX, which is the average of both. Now, India VIX, let us suppose it is 20%. So what does it mean to me if I am holding a portfolio? It is only an annualized reading. It is an annualized percentage. So if I am maintaining a portfolio, I will look at how much monthly gyrations may be there. So how to arrive to that particular monthly gyration? 20%. So 20 divided by square root of 12. If you do this calculation, square root of 12 comes to around 3.5. So 20 divided by 3.5, that gives you an indication of 6% around, 5%, 5.5% around volatility during a month. So if I am holding a portfolio, this figure comes directly to my mind that the market possibly may hover plus minus 5% or 5.5%. Once I understand this kind of volatility which is giving, now as Siddharth mentioned, this is the implied volatility. Obviously, it gives me an indication how much future movement of the Nifty may be there. So the Nifty movement is, I have come to the conclusion it is plus minus 5.5%. Now what I can do now? I can hedge this by either going short in Nifty, or I can hedge this by going long in India VIX futures, because numerous times we have seen it has a negative correlation with Nifty. So how many contracts? So that you can do. You can look at the contract size of Nifty and this thing, or you can look at the contract size of India VIX and your portfolio total. You can go for beta hedging. But the question is how many lots, so that you can arrive now. But the best part is you are doing this to hedge around the minus 5% or plus 5% kind of volatility in the market. So that is an important feature that India VIX spot gives to me.
Right. Siddharth?
Yeah, I would second Yogesh's opinion on this, that this cannot be considered as a separate asset class as such, because a tool which you use for hedging can either be a hedging tool or a speculative tool. When we talk about speculation, we talk about trading. So, it being part of a portfolio in a turbulent time or in an anticipation of turbulent time coming ahead, that particular time it can be part of my portfolio, but it cannot be part of my portfolio for prolonged period of time. Just like when you say an investor is investing with a 1 year, 2 year, 3 year time horizon, VIX cannot be that way. But yes, as an investor, I can move in and out of VIX during the time duration of my portfolio.
Sure, thanks. And as all of you would have observed, like starting from today, India VIX index values are being computed and disseminated up to 4 decimals, which are rounded to the nearest 0.0025. This has been done to provide more precision to the index number itself. So any views from your side as to like how this could be more beneficial for the participants?
Definitely, to understand an underlying which has a higher price, maybe a little bit easier than understanding a price which is around 15 or 16 rupees. No doubt about this. But having said this, higher contract value of India VIX may be a little deterrent in the beginning. But over the period, once you start getting the liquidity in the product, I think you will have more retail participants into the product. And over the period, if you can reduce the market, the overall contract value also, so that possibly may bring more liquidity into the product. But for the timing, I think multiplying by 100, understanding 19 into 100, definitely this is relatively better. But the only impact is it is increasing the higher contract value.
I have slight different opinion on this. If I look from a regulator's perspective, implied volatility, selected few of us in market also, if you look at participants, though people are trading in options, but the concept of how volatility moves is not very clear at this point of time. So probably, the regulator to safeguard the retail investors is thinking of higher lot size at this point of time, the contract value of 10 lakhs which has been defined in the product. Now, once the product is out, and because the product is quite, when I say product, the underlying of the product is quite volatile, you would have, HNIs and institutions having good interest in this product. This would certainly attract retail and other HNIs who are not participating because of higher contract value. Their attention would be attracted towards it. And once the nuisance of product is clear to these people, they understand the product properly, the liquidity in the product increases. I think, I'm sure exchange and regulators would take a step of larger inclusions of masses by reducing the contract value. So, and coming to your question about having 4 decimals, certainly you guys, as Amit is pointing out, are going to multiply it by 100, and the say a volatility index of say 20% would be trading at 2000 levels, and hence your tick size of 25 bips. Certainly, it should. I don't know whether it would give a very big dimension, but yes, 25 basis tick to compare to Nifty's 5 basis tick is good enough for a product which is very volatile.
Sure. From my side, I would like to add slightly on an institutional level what we expect in the near future from the VIX is that, as you have mentioned, that it would be a weekly contract for 3 weeks outstanding. There are many institutional or the FI clients who would wish to hedge their portfolios for a slightly longer duration, because on a weekly basis it would be, as Siddharth and Amit has rightly mentioned, it would be a trading tool. It would not be a entire option basket hedging tool which can be really used, where we require at least a month, 2 months, or say something like that, or say you can have 6 weekly, which is 1.5 months time frame. Like that way, those future contracts which will be useful for hedging the entire option portfolio, which is on a larger basis. Undoubtedly, liquidity would be low in terms of as we spread out to more future contracts opening, but there could be participants who can really express their view by going long and short, not on the screen traded one, but as I say, negotiated ones in terms of the on the screen, but there are views which are taken for a longer duration by the participation that can bring a newer aspect to the entire VIX futures markets.
In fact, what Yogesh is saying is quite interesting. Today we have, liquidity when a contract starts in only in the first month contract, and next 2 months contracts are not so liquid. But key to this product, I believe, would be and should be that the liquidity in all 3 weekly contracts is there. That is when, a person who has monthly exposure in option can trade in 3-week contract rather than concentrating on a 1-week contract basis. And the spread strategy which he was talking about can also happen when there is a liquidity in all 3 contracts. So that is where probably, the exchange and the participants has to be careful about.
I would add one point here. See, there are 3 weekly contracts. So let us suppose there is an event on Thursday, and before this the volatility spikes up. Generally the tendency of the volatility is it generally cools off after the certain event, and you have an expiry on Tuesday of every week. Then it is possible, it has to be seen rather, whether that particular future is going to be trading at a discount or at a premium. Because the way the volatility starts coming down after the event, generally the people will have a tendency to go short in volatility, because it is going to expire very soon. And instead, in the next weekly contract, they will not be doing that. So that throws an opportunity to us that we can form the calendar spread, what Yogesh was talking about. That difference, possibly this is a discount and that is not in discount. You can go short in the higher premium thing and go long in the lower premium thing. So that may be a calendar spread one can use with this opportunity.
In terms of expressing views on the volatility as a directional play, so Yogesh mentioned about that point. Any other views from Amit and Siddharth on that?
See, I think it is just like a price to earning. If it is coming down to a certain level, like what we have seen, Nifty generally bounces from 20, 13 price to earning ratios. Similarly, volatility also generally bounces from 13, 14 kind of ratio. Now, if somebody has, the willing of holding it for a longer period, he can buy directly the par month and keep on rolling it. Whenever the volatility comes down to 13, 14%, this way at least not immediately, when the volatility starts spiking from such good levels, he will make money. So that is one trade actually that one can do whenever it is coming down, because on the higher side, generally the variations are a little more, because it can stop at 20, sometimes it can stop at 25, and when the markets are really volatile, then it can go a little bit much higher. So going long from the low volatility part and looking for a positional trade may work.
In India, we have a lot of events, be it RBI policy, quarterly numbers, elections, then we are so much vulnerable to what happens in global environment. So last 3-4 years, we all have noticed that after every fortnight or month we have large event which spikes or decrease the volatility big time. Now this product can be a very useful and tool to capture those volatilities or capture potential profit from those volatilities. So yes, it is a speculative, I'm going to say this instrument can be used and I'm sure will be used by a lot of participants who at initial stage would have money power in terms of taking the exposure in this instrument, and big upside can be made using this product. One has to understand over here that risk management is key to this product. Volatility, as I was mentioning earlier, that volatility index itself is so volatile that if your call on volatility index goes wrong, you may face big losses in this product, and if your call is going right, you can make big money. We can, debate and discuss and argue on the margin part of it, but I agree with the exchange on this front that the margins are on the steeper side because the volatility itself of the underlying is so steep. So if you charge less margin on this product, risk management failure chances can be there. So it's a brilliant product, but all depends on how awareness is spread about this product to end users, and also how people understand nuances of this product in terms of that this is not a underlying which goes in one particular direction. This has mean reversion sort of behavior, but in different market scenarios, the range of VIX is different. So that is the key thing which I would like to highlight over here.
So one thing you can add, we have been talking with various clients. Generally one question comes that if you have a long portfolio, I can go short in Nifty, why should I go long in India VIX? Correct. It's a very common question that comes to us. The answer may be blessing in disguise. India VIX, we have seen when the market moves up, the tendency is it should go down. And what you have done, you have a long portfolio, so you bought India VIX futures. But there are times when the people are heavily sold in call options in Nifty, and when the market moves up, that kind of breakout we see and the volatility spikes. So you can make money in both the legs, which possibly you may not do if you are hedging with Nifty.
Correct.
Good point, Amit. So what I have noted based on inputs from all of you, the likely uses of NVIX futures would be for hedging the equity portfolio, could give more opportunities in terms of spread trading. The directional views on volatility could be expressed using this product. And I appreciate the point made by Siddharth about risk management is definitely going to be a key thing in this. So just to sum up, just a last question to all of you. What could be one or two important points which you feel are measures which are required or could be useful for taking this product forward, or just to build a very strong ecosystem for development of the market? So starting with Amit.
I think we are going into the same lines of what S&P had done years back. They came out with futures, S&P futures, CBOE VIX futures, which was based on S&P options. And afterwards, when they started getting liquidity, they started the CBOE VIX options. Now you see what has happened there over the period. CBOE VIX options, even in a single contract, whatever volumes are there, in a single strike, the same volume we have seen in the futures, in the overall futures of near month contract. So that is how the options market in CBOE VIX has developed over the period. And when we come to India, I take proud in saying that we have understood, or possibly whether it's a speculative method we have adopted or whatever strategies. In India, the Nifty options, the volumes, the way it is rising day by day, the awareness that is spreading out by the various brokers or the advisories, and that has led to understanding of the options more, and that's why we have introduced India VIX. I think it will be great after India VIX if we introduce the India VIX options also over the period.
Sure. In fact, Amit, I would also like to highlight one point here. You mentioned about depth of our Nifty options market. So last year, as per FI records, Nifty options is the largest traded index options contract globally.
Yep.
Yeah. As you mentioned about taking pride in that, all of us in India definitely take a pride in having a largest traded global product in our market. So, Siddharth, what are your viewpoints? What could be the two measures which could really help in market development for this product?
I think balance is what investors, balance is what brokers and exchange seek from this market. Getting too much speculative in one particular product, though even I take pride that in 2004 the options volume was not even 5% of total turnover, and today option volume is 75-80% of total turnover. But we should keep in line the structure of this market. We should not forget that the volatility index is derivative of a derivative. So getting too much speculative because there is too much of volatility in this underlying, overexposure in this underlying, can lead us into trouble. Regulators are very agile, very they have hawk eye on what is happening on market and what is in terms of beneficial to the large masses. I would again emphasize here also, Vittal, that risk management would be success for this product. Product per se understanding should not be a problem because people are understanding details of option trading. And yes, this is one more additional tool. Completely agreed with Amit on that front, that if you want to take this product forward, first we need to have liquidity in volatility index futures. Unless and until we don't have liquidity in VIX futures, we should not go for options. Options should come only when there is good amount of liquidity in futures.
Yogesh?
Yeah, Vittal, I think largely the points have been completed, but would like to add one point, which is, I think, awareness to the retailers and also the other participants. Added to that is, if you can run an incentive-based program for the liquidity providers. See, I'm not asking about, say, a very high incentive program or something, but in the initial days to make the product successful, you need to provide liquidity. Now, liquidity is something that in a market where everyone is on the first side, you have to create an opposite side to the same. So if you can provide some incentive-based programs to provide liquidity, this can be, say, on the basis of volume, the number of, opposite trades which can provide, that will develop the liquidity in the beginning, and as liquidity comes in, liquidity pulls liquidity. That's a simple fund of any market across the asset classes which we have seen. So that could be one suggestion from my side to improve the liquidity and usability of the product.
Thanks, Yogesh. So I think we can start taking questions from participants. The first question is from Mr. Bharat Shah, Ventura. VIX and Nifty largely have a negative correlation. So is it possible to construct pair trading between India VIX futures and Nifty futures? If yes, then how it will work?
See, India VIX, as I think Siddharth mentioned in between the conversation, that India VIX, it's not like that 100% of the time. When Nifty is falling, India VIX moves up. There are chances, the probability is high, around 80% of the time. Generally, when the market falls, India VIX moves up. So if you understand this particular thing, then definitely you can form the pair strategy. Or if you are talking about the long portfolios, it is same like you are long in Nifty. So if you are long in Nifty, we were talking about going long in India VIX, maybe a good hedge. So if it can be a good hedge, it can be a good pair strategy also.
In simple words, I would say that yes, this can be a pair trade, can be done in this, but with a condition. Say you have a volatility index range of 15 and 20, suppose. Then do a pair trade when it is at 15 and do a pair trade when it is at 20. Don't do in between.
The next question is from Mr. G.M. Rao. I think Yogesh, you can take it. Sir, I am a trader. How can I use volatility for my advantage? Very generic one.
Obviously, any strategy is only for the advantage. Whenever we trade for disadvantage. Obviously, as we have been having a discussion around saying that the VIX index has a range. You need to predict which market you are and which range you want to trade in. So if you feel that, okay, in the last couple of duration, the VIX hasn't bottomed out at a certain level, at peaked out at a certain level, you can trade it as a directional strategy for them. So, but obviously, rightly mentioned that the volatility of VIX itself has been 60-70%. So you need to know about the risk-reward basis. So to trade it in, say, a directional manner.
We can add one more thing here. So far, we don't have India VIX options, right? We only have the Nifty options with us, where I think we guys over the period have understood a lot, even the participants. Now, if volatility India VIX is trading, let us suppose at 16 levels or 17 levels, and in Nifty options, because of the market dynamics, you see the market has come down, and there is a heavy build-up in 6200 or any particular strike of call options. Then, over the period, the market tendency is it possibly goes for a breakout. Those particular open interest is likely to be, taken out, and that creates a volatility. So, I am not saying you just look at the India VIX futures and trade. You can look at the Nifty options data. Understand that why ultimately this particular India VIX movement, futures movement may come, because it is driving its value from Nifty options value only. So, once you understand that, you can take a call on India VIX futures, speculative also.
Thanks, Amit and Yogesh, for this. Before I take any further questions, let me just reiterate the disclaimer. So this is just an educational series which Exchange is conducting. So there is nothing, this is not to be used as trading advice or advisory for trading purposes. It is purely for educational purposes. The seminar or the webinar content should be used. So the next question is, could you please explain how to hedge volatility risk with examples, which I think Siddharth has provided all the details. Siddharth, next question is for you, where participants want to know typically if Nifty moves by 1 point down, how much would India VIX be impacted? So what could be and how that information could be used for deciding on either the hedging or the trading strategy?
There is no clear-cut answer to it. Sometimes it can move by 0 decimal points, and sometimes without Nifty moving, volatility can move in big way. Don't try to generate correlation between Nifty and volatility on very short duration time basis. Generally, just like in Nifty, where you see support, resistance, breakout, breakdown, and go long or short in Nifty, in same way you may not be able to do it on VIX index. If somebody is a technical analyst and is thinking that I will see implied volatility chart and I will go long and short on intraday basis, would be taken by surprise that it won't behave the way he or she is thinking about it. So there is no clear-cut answer to it. It is very dependent. Just like option pricing is not just dependent on one particular factor. There are various other factors. Similarly, if Nifty moves up or down by 1 point, IVs would move in certain particular direction. There is no clear-cut answer to it because there are a lot of other factors. Imagine that there is sudden news in market which may not have led to significant move in market, but may lead a lot of participants to think that there would be significant move probably after 1 week. So in that kind of scenario, your Nifty is not moving, but your VIX index would have shot up. So don't try to draw this very short-term correlations between Nifty and VIX.
Okay. Thanks.
I'll take forward what Siddharth has said. The VIX index is the value of futuristic volatility, not today's volatility, which is the base definition for VIX index. So if anything moves in the VIX index, that is for futuristic move in the underlying, not today. So rightly mentioned, don't look at it in a synchronized manner on a day-to-day basis. It's something view for the future.
Thanks, Yogesh. The next question is for Amit. Mr. Ravi Biani from Wickup wants to know, will futures be in a premium for one expiry to another, or it can be at a discount? And what does this depend on?
See, as I mentioned, it has to be seen how the market participants are taking this, because if there is any event during a week and you have an expiry afterwards, so we need to see that whether the volatility remains at the elevated level or it starts coming down on the expiry day. And how the next, because we don't have the liquidity so far. See, in Nifty also, there are certain stocks where it is difficult to understand why they are trading in discount. Previously, we had seen a lot of stocks which were trading in discount, and the next month was further trading in discount, and there was not much dividend, no dividend. Same way, if we are talking about India VIX, it has to be seen how the volatility and the future volatility, the carrying forward positions that people are taking, and that's why whether the future or discount remains. So right now difficult to say, but it has to be seen.
Theoretically, I believe it should be more or less in premium. And why I say so is because your underlying is very volatile. Underlying is volatility index. And you are getting an exposure of, say, on a conservative basis, I'll say 50% exposure to your money. So a thing which can move 50-60% in matter of 4-5 trading sessions, and you are getting leverage of 50%, there would certainly be a cost of carry associated with it, and hence theoretically most of the futures should trade in premium. And as Amit was pointing out, that depending upon situation to situation, it may go into discount as well. But I believe maximum time, just like Nifty, should trade in premium.
Thanks, Siddharth. We have a question from Mr. RMCV Prasad Rao. How to guide investors by using this tool to safeguard their investment? I think we have almost discussed multiple trading strategies as well as utilities of NVIX futures, how it could be used for portfolio diversification, how it could be used for any spread opportunities or a directional view. I think that answers the questions of Mr. Prasad Rao. Siddharth, this question is for you from Sir Vishnu. Is what has been the long-term range of VIX? And how could, in fact, you mentioned about range-bound nature or mean diversion kind of characteristics of India VIX. So the question is like, what typically has been the long-term range? Because you have been tracking India VIX so closely in all your research reports. And what does that mean to the investors?
Theoretically, a low IV means people are complacent. High IV means people are scared. In different kind of market scenarios, we have observed different volatility ranges. Now, we have observed implied volatility ranges, and we have seen that implied volatility and volatility index are more or less near to each other in 99% of cases. So what I am sharing with you right now is implied volatility ranges for different market scenarios we have observed since 2005-2006. In a bullish market scenario, a low IV of a 14% IV is considered as a low IV. Around 21-22% IV is considered as a high IV. In a bearish market scenario, 21-22 IV is considered, or 19-20 IV is considered as very low IV, and 30-35% IV is considered as higher side of the IV. And your range bound market 18-19 is high and 13-14 is low. Again here, as I mentioned before also, important aspect you need to gauge yourself, which nobody else can tell you, is in which kind of market scenario we are into. And then decide that whether this IV is on the lower side or on the higher side of the range.
Okay, thanks. So there is a question from participants whether there will be any recorded webinar that would be available. So just to inform that this recorded webinar would be available on NSE's website, where we have specifically created a microsite for NVIX. So under NVIX, under section of Learn More, all these historical or the earlier webinars recording would be available for participants. The next question is, what is the market lot for NVIX futures? So I think I will take that question. Currently, at the time of introduction, we will have the NVIX futures contract value minimum of rupees 10 lakhs. So depending on the index value of India VIX, the lot size would be determined. So tomorrow, that is Tuesday, February 25th, we will issue a circular where we will provide the details of the exact lot size to start with for the NVIX futures. So I think we have taken all the questions which have been provided by participants, and we are just at the close of the session. If there are any other questions which have not been answered, we will come back to the respective participants with the answers from our panelists. So thanks a lot, Amit, Siddharth, and Yogesh for having such an interactive discussions and providing a lot of insights on NVIX futures. I hope our investors are benefited. Definitely, I'm sure about it. They will be benefited with this additional understanding information which has been provided during this webinar. We look forward to continuing this kind of webinar series for increasing awareness and increasing the or providing information about the opportunities for participants to understand the opportunities of NVIX futures going forward. So thanks everyone. Thanks audience for logging to our webinar. The recorded version, as I mentioned, would be available on our website in case any of your colleagues would have missed it. You can definitely listen to Siddharth, Amit, and Yogesh subsequently. Thanks a lot and have a great day ahead. Thank you.
Thanks a lot.
Thanks.